it's actually doing exactly what consumer confidence has been doing. So, yes, I mean, the Fed hiking cycle will end in recession. I think the question is timing, or, working thesis, house view is, around the middle of next year. So that still leaves plenty of time in between, is the way I would put it. Yes, but if we go into a recession, yes, 3,000.
If we go to 3,000, I'm right. If we go to 4,750, I'm right. Binky, that's just the way
it's a question of when. It's a question of when, John.
Well, Binky, I just want to give you the chance then, because it's not for me to say your forecast is going to be wrong. You're saying that we can rally back basically towards all-time highs before year end.
That is correct.
Okay.
If you look at basically, big corrections in the S&P 500, and generally, I mean, the kind of levels that we are talking about right now, where we are, you only see basically in recessions. But in the few cases when we fell by as much, and we did not actually go into a recession, the market actually regained its prior peaks in about 4 months. So that's something to keep in mind. So the question is the recession happening, and is it becoming more imminent, or is it getting pushed out? So whether you look at CEO confidence, whether you listen to company commentary, whether you look at the labor market data we just got yesterday, all of that saying it's postponed a little bit.
At the end of a football game, American football, when there's like 20 seconds to go and they're sort of deep in the field and they throw, what's it called, Bram? A Hail Mary?
Yeah, Hail Mary.
This feels like a Hail Mary into year end. Binky, if it lands, credit to you, and we'll talk about it.
Do you know who Doug Flutie is?
Who's
Have you ever heard the name Doug Flutie?
Who's that, Tom?
That's a guy you need to study.
Okay.
He's the king of the Hail Mary.
King of the Hail Mary. I'll check it out. Binky Cheddar at Deutsche Bank. Thank you, sir. Futures up a third of 1%. Hey, you wanted a bull.
There we are.
We got it. Delivered.
There we go.
Signed and sealed.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Hurricane Ian is taking aim at South Carolina. The storm's winds picked up to 85 miles an hour overnight, and it's expected to make landfall today north of the historic city of Charleston. Ian caused catastrophic damage in Florida, where it came ashore as one of the strongest hurricanes ever to hit the U.S. The storm flooded towns on both coasts and wiped out entire neighborhoods. An unknown number of people are still believed to be trapped in their homes. British Prime Minister Liz Truss won't change course on the government's unfunded tax cuts. That's following talks with the government's budget watchdog following a week of market turmoil. Bloomberg's learned Chancellor Kwasi Kwarteng will stick to his plan of delivering a medium-term fiscal statement on November 23rd. In Brussels, European Union energy ministers have backed a package of measures to fix the natural gas crisis. They include a goal to reduce power consumption and agreeing to tap windfall profits of energy companies. Still, there's some frustration that more hasn't been done. Vladimir Putin is set today to annex parts of Ukraine that Russian troops control, and that's after a referendum condemned by the United Nations and called a sham by President Biden. Russia plans to sign treaties to absorb the 4 Ukrainian regions. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball so their apps would surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are in Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Lenny Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg. No one covers the world like Bloomberg.
Russia will then absorb these territories. What is NATO's reaction?
Italy's Giorgia Meloni wins a clear majority, ushering in the nation's most right-wing government since World War II.
The Fed offers no sign that it is ready to stop tightening.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Bearish European natural gas going into January and February and see it trading below 100 euros per megawatt hour. We believe, barring an absolutely freezing cold winter, they're going to get through this winter. Prices are going to moderate, but longer term, you have a problem.
Jeff Curry, constructive short term, very much not constructive long term there. Global Head of Commodities Research at Goldman Sachs. I'm told that if I've never heard of Doug Flutie, that's like not knowing who Paul Gascoigne is. But since you guys don't know who Gaza is, I'm not going to go there.
That's absolutely correct.
Futures up a third of 1% on the S&P. On the Nasdaq 100, up a quarter of 1%. Elsewhere, yields are lower by 9 basis points on a 10-year, 369.81. Euro dollar, 97.57, down 0.6%. If you missed it, a couple of hours ago, we had inflation out of Europe, double digits, 10%. Next ECB meeting, October 27, and they've got CPI year-end at 8.1%, next year at 5.5, the year after that 2.3. Double-digit inflation, Tom, in Germany, double-digit inflation in the Eurozone.
On a slow Friday, folks, I really want to emphasize, as John just mentioned, there is no bet on euro in the last hour, and also on sterling. Is it inflammatory? No, but it's tangible. They have given way off of the news flow of the last hour that you've seen, including our interview with the Prime Minister Truss's Treasury minister of some form, a city minister as well. Right now, we speak to Minister today on Brussels and Minister Horton in Washington about the events of the weekend. Maria, I'm going to go to you, and that it's the only question I've received this weekend as people stop me on the street. Who's going after Vladimir Putin? How alone this weekend is Vladimir Putin?
But actually, Tom, I thought I'd be a prime minister more than minister. But, you know, in terms of who's going after Vladimir Putin, it's a very difficult question to answer. And in all seriousness, it is a difficult question to answer because the Europeans, what they say is, we are not fighting this war. We're not belligerent in this. We are supporting Ukraine because this is a country that is being attacked on the battlefield. But I can tell you, though, that the Europeans know that in about an hour's time, Vladimir Putin will announce that he will annex 4 regions in Ukraine, and that will pave the way for more sanctions on Russia. Now, it is unclear what type of sanctions, because the Europeans have pretty much done everything that they could. The one issue they can't is gas and energy, and there is huge frustration here about the fact that bills and prices are not going down fast enough.
Has this dialogue, Maria, changed with the Italian election? The reality of the politics of Hungary and other Eastern European nations. Are we having a different conversation now on sanctions and on Vladimir Putin than we had on February 25th?
There is a different conversation, but so far it's not in sanctions. It's about this mega plan that Germany presented yesterday. Remember, it's 200 billion euros in new debt to be able to finance and cushion the impact of this crisis for households and families. And what I can tell you, Tom, is that behind the scenes today in Brussels, there's frustration at the Germans. The idea that they are disrupting in some ways the markets, that they are breaking away from that solidarity and that unity in Europe because they have the money to do things that other countries are not able to. So in fact, the conversation is not so much about the sanctions, whether it changes or not, but it's more about whether Germany is going at it alone or will stick with the rest of European countries.
And Marie, the way that Europe is configured right now, they're proposing to borrow money to try to plug the gap in the energy system right now for households, for companies, and beyond. How much, when we look at the U.S. and some of the spending that needs to happen on infrastructure and some of the spending that needs to happen to recover the situation down in Florida right now, the disaster where you do need to rebuild, how much does the U.S. have that capacity to do that, given some of the projections?
Well, they really don't have a choice, right? This is a natural disaster. This is a defying moment for not just the governor, Ron DeSantis, but also, of course, of President Biden. There was a great analysis this morning in the Washington Post that really showed, and to Tom's point yesterday, how this can shape a presidency. And it is really crucial to make sure that the federal government is seen as really being as a helping hand to opening the taps on whatever is needed, especially when you're looking ahead to a midterm election. If I could just say one point to Maria's about Germany and that they're in this incredibly more secure fiscal situation. I was kind of struck by the German economy minister's comments this morning, Robert Habeck, taking a little bit of a direct call to the places like Norway, like the United States, which are now starting to fill that gap where Germany used to get very cheap Russian gas. Sometimes others would maybe say at the expense of other European countries. Now basically telling those countries that Europe should be in a negotiating power and making sure those countries are not exploiting these sky-high prices.
Okay.
And what you should note about what's going on in the U.S. right now is they are making a lot of money in terms of sending over fossil fuels to Europe.
So, Anne-Marie, to that point, I mean, what's the pushback from the United States? Is there some sort of response? If there is going to be increasing pressure to lower the prices, is there a willingness to do that for an alliance and trying to keep Europe in a better situation during the winter?
Well, this is Mr. Habeck's response. We need to be an alliance. Should be a partnership. And the United States is, I'm sure, going at all of these moments. And they've said they want to help Europe. They are shipping tons, the most ever on record, of LNG to Europe. But these are private companies, and these are supply and demand issues. And I'm not sure I see the United States going to be able to put pressure on LNG companies to lower their prices to fill the gap in Europe, especially when Europe is in this very vulnerable time and they almost just don't have a choice.
AMH, thank you. Anne-Marie down in DC alongside Maria Tadeo over in Brussels. TK, you are never going to win Maria over. You know that, don't you?
Yeah,
it's just not happening.
It's like
You're going to keep trying, though. It's not working out. Thanks to Joe Weisenthal of the Odd Lots team for writing this one up. Bloomberg's chief economist of financial products, Michael McDonough, put this together. Tom, if you wanted to spend $2,500 a month on a house, that would cost $476,000. For that same monthly payment, you could have purchased a $758,000 house in early 2021. That's just how much interest rates have changed. So a $2,500 payment a year ago, Tom, your house is $760.
Right.
Now that house is going to cost you $476.
37%.
Your budget has shifted massively.
Well, and culturally as well, 37% decline in value. Thank you, Liz Ann Saunders and David Gura, for selling that out on Twitter for Mr. McDonough. John, you see it as well, and I really don't understand this market. The Telegraph moments ago with an HSBC analysis of the mortgage payment from, I believe, fixed to floating. John, correct me on this, moving from an annual £3,500 increase to £5,000 increase.
So those fixed mortgages, Tom, once they're done with, you're going to get a big step up in interest payments. I think there's a big wall of that set to take place in about 12 months. Then about 20% of the mortgage market in the UK is floating rate, variable rate mortgages, Tom. So that will adjust off the BOE's next big move, and it's going to be a big one.
Yeah, I'll have to see.
Futures positive a third of 1% on the S&P from New York. This is Bloomberg.
watching and says, I want to be Ari Emanuel when I grow up, what should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Live from New York, looking for a bounce here, up a 0.5%, just about, up 0.4% on the S&P. On the Nasdaq, up 0.4% also. On the Russell, small caps up 0.6%. On the quarter on the Nasdaq, third straight quarterly decline we're poised for here. Worst since the third quarter of 2002, that losing streak. That's unreal. I had no idea about this. And a quarterly decline was set for on the S&P as well. Another quarter of it, longest quarterly losing streak going back to 2009. We haven't seen this for a long, long time. That's the equity market story. Here's the bond market, all over the place. Your 10-year now, 369.21, yield to lower 9 basis points. We've gone from through 4% early this week and down to 369, quite a range. You want a bigger range than that? Look at pound sterling, 103.50 Monday morning, 103.50. Then all the way back through 111, looking at 112, and now back to 110.71. You're up to speed with this one, Tom. Cable, what a range.
Yeah, well, the range is there, and there is some resistance. I mean, you can make a chart, and up it goes, and there's something it has to break through. But what's important here on a weekly chart, John, there's no support. Technically, it's what I call soup, in that it's hugely indeterminate. And that tells me, John, it's based off every single Bloomberg headline and red sticky that we're going to see from the trust government. That's really, you know, you may get some liability-driven scandal in derivatives, but to me, it's mostly the trust government news flow.
Yeah, and getting the sequencing in order. And Lisa, also, there were some thoughts this morning that maybe they'd accelerate that planned economic forecast from the OBR, and that doesn't seem to have happened in that meeting this morning.
Well, not only did that not happen, but our reporting is that they didn't even request it. So, John, you do have to wonder, are they even thinking like that? Are they just hoping, the storm will pass, and if we just jawbone enough, the markets will cooperate?
We'll see. We'll see.
Meanwhile, one thing that I'm looking at, and that's on the sort of macro picture that you were talking about, is just some of these specific names as they report earnings, and Nike really caught my eye. The good news, I guess, is that you can get things on sale there. That seems to be the takeaway headline here, because their inventory surged by 65%, well beyond what people had expected. Margins came in much more, really difficult for them. Basically, they have all of this stuff that they can't sell as quickly as they thought that they were. It's building up, and so they have to discount it aggressively to get it out. They're not alone. Those shares down nearly 10% in pre-market trading year to date. It's been a bloodbath in the retail sector. I mean, it's been incredibly difficult at a moment where they really haven't kept pace with some of the shifting trends in shopping, as well as just people buying less stuff. Nike shares down, just not even including today's move intraday, if it sticks, 43%. Adidas down almost 60% as they deal with some of the same issues, and Under Armour down 64%. So actually, with all of this, Nike's actually doing the best, but it is an incredibly difficult moment, and this is one reason why investors come on and they're looking for an entry point for some of these. They say that early next year, and this goes to the point that Michael Hartnett over at Bank of America was talking about, at a certain point, have we just completely stripped valuations to such a low level for some of these names that got first, that were hit hardest and first, that they start to become attractive, perhaps, when we start to understand the scope of the downturn.
Lisa, thanks so much. Right now, on what you're going to do to restructure for Q4, restructure your life as we're all poor in the equity market, Marvin Lowe joins us, Senior Global Macro Strategist at State Street. Marvin, when you take the global strategy and you fold it into the investment strategy, what is your to-do list the first business day of October?
I mean, I think you're still trying to assess how comfortable you feel with the path that's been laid out on the monetary policy front. If you're getting comfortable with that, you could certainly talk about some of the bottom fishing that Lisa talked about. We, on the other hand, still think that there's a great deal of uncertainty. So you stay defensive. You still continue to look at the shape of the curve that put you in a defensive position. And, you know, this dollar strength that seems to be making its way around the world is something that will likely continue in our view.
We have seen central banks in some forms blink in the last number of days. In all my reading, Marvin, including this weekend, whenever I see the word hope, I circle it, because that usually means danger. What is our hope for the Central Bank of the United States? What are we hoping Jerome Powell does?
I mean, I think we're hoping that they stick with the script that they put out, as painful as it's going to be. We see kind of how inconsistent some of the central banks messages are needing to be, particularly around the UK, where on the one hand they say they need to tighten, but on the other hand they've started QE again. Certainly potentially a one-off. That's the hope, but it really does show how challenging an environment it is. You can't deal with the systemic risk that's building in the market the way you used to because of this inflation. So I think that we really need for the Fed to stay with their message and make inflation the main enemy that they're going to fight.
Marvin, we just had Binky Chadha on a bit ago here on the show from Deutsche Bank, and he was saying he still thinks that you could see a 4,700 level on the S&P by year end because of a bear market rally. Are things that volatile that you could see that kind of move, that you could actually see rallies of a significant magnitude that would give you as a defensive investor an opportunity to sell?
I mean, 47 feels pretty aggressive to me. It would be a repeat of the summer for the most part, and I don't think we're going to have an environment that allows the summer to repeat. If anything, the Fed is in a mode to make sure that doesn't happen again. Can we have a bear market rally? Sure, absolutely. 8 to 10% in this kind of environment is not unheard of, and it does provide you an opportunity if you're short-term in nature. I still think U.S. stocks for the long term is part of your portfolio, but between here and there, there's going to be a lot of volatility around it. And I'd add that the VIX certainly has crept up, but it's not at concerning levels. So you really haven't had that feel of capitulation, even though you've had as much volatility as you've seen on the price front.
Marvin, you said that we haven't seen that capitulation yet, and that certainly has been what a lot of people are saying. But around the margins, it feels like something is happening that is different now than a couple of weeks ago. Over the past week, we saw the biggest withdrawal from U.S. investment-grade bond funds on record. We have seen losses in that debt unrivaled in memory in recent history, and even not so recent history, of nearly 18% so far year to date. Are things starting to crack in credit?
Yeah, they absolutely are. Kind of having said that, Lisa, and you certainly know the high yield market as well as anybody else, we're still a ways from retesting the wides from a spread perspective that we saw earlier this year, and those wides didn't reflect recession the way that we would typically define it. So it is starting to crack. There's reality coming into those markets at a time when they were able to ultimately talk through them. Kind of having said that, if that reality does set in, there's still more losses that are going to come into that market.
Marvin, off script, but I think on the mind of everyone on global Wall Street is we all calculated the leverage of 1998 that we observed. I'm going to use 16 to 1, even 20 to 1. And I guess there's a comfort that the ratios that we're talking about in the last couple of days is a 3 to 1 imputed leverage as well. Is the leverage out there within the financial system to give Andrew Lowe upset at the Massachusetts Institute of Technology that would upset Marvin Lowe at State Street?
I mean, I think we definitely have had a better handle on leverage this time around, relative to a few of the other financial crises. So I'm not necessarily looking at it from that perspective. Having said that, what we learned from the UK pension funds is that it could lurk in sometimes the most obvious places. It doesn't make sense in hindsight, but these are strategies that potentially evolved over a decade in an environment that was very much geared towards lower interest rates and in a more stable environment. I wouldn't say it's there, but there's nothing obvious to me relative to what we learned, really over the last few decades and unfortunately a few of the last financial crises that we've gone through.
Marvin Lowe, thanks for being with us, sir, of State Street. Still 3 months to go of this year. Yeah. I keep saying that. It's been such a long year already. What a story through the third quarter, never mind the whole of 22 so far. Futures, Tom, up 0.2%. Sterling now weaker on the day. Cable, big turnaround in the last couple of hours. I've got to say, this market, Tom, has just been all over the place all week.
I looked away for 12 seconds and sterling weaker again. Careful to watch. I'm not in a panic about it, but hey, there it is. John David Blanchflower, very busy and all out on Twitter, thinking of him and the millions in Florida affected. The professor from Dartmouth College with a set of blistering tweets. John, this sounds like Pharaoh about 6:02 a.m. However, they said the forecast, which we'll receive on 7 October, won't be published until 23 November. The government also said it values the OBR scrutiny. What a load of rubbish. Not going to happen. We won't let them hide this stuff. Appalling. John, that sums up the street.
So that's the second piece. I'll ignore the second piece, Tom, because that's heavy on opinion. Let's talk about the first piece of this. November 23rd. I wonder, Tom, whether this new budget now, and it's certainly not a view unique to me, that if it includes spending cuts in a big way to offset some of this, TK, I just wonder how much more painful this could become in the next 6 weeks, next 2 months for that matter.
I urge everybody to, I'll put it out on Twitter, John. Everybody's got to go read William Greider on David Stockman, written in 1981. I'll read it this weekend, as I did 40 years ago. I can't believe I'm saying it. John, this has so been there, done that before.
Sure.
It's shocking.
Tom, this started...
That's why I got upset with the minister.
This, Tom, started, I think, when you had Boris Johnson on his way out. And on his way out, he talked about the Treasury. And he talked about the Treasury and how they like to balance the books, and they're too focused on that and maybe not on growth. And then the first thing they did when they took over is they basically fired a top civil servant at the Treasury. This is how the dominoes started to fall. The Chancellor came on board. He said they were ran more like a finance ministry. They want to focus on growth, and it's gone from there. Tom, if you're going to blow up orthodoxy, that's one thing from a policy front. But if you're going to do it on your approach as well, that's going to unnerve a lot of people.
Yeah, well said, John. I haven't asked this question because I don't want to be rude, but I'll be rude to you. Would this have happened under Prime Minister Johnson?
Tough to say, Tom. Tough to say. I think under Prime Minister Boris Johnson, you maybe have got your own idea about what policy should have been. So Tom Scholar was still at the Treasury at that point.
The gentleman.
That gentleman, that top civil servant at the Treasury, he didn't blow up the approach in quite the same way as this government has done in the last couple of weeks, Tom. And it's the approach, again, I really draw a distinction between the policy, and we can have a debate about whether this is the right policy, but the approach, to blow up the approach, to say that we're going to do this without the OBR forecast alongside us, that kind of stuff is just, it's messy, and it's been messy, and you've seen how it's played out in the market too. Futures right now, positive 1/3 of 1% on the S&P. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Hurricane Ian's winds have picked up speed, and the storm's on a path to hit South Carolina. The forecast calls for Ian to come ashore north of Charleston today with heavy rain and a potentially deadly storm surge. Florida is struggling to recover after Ian made landfall as one of the strongest hurricanes ever in the U.S. Entire communities were wiped out and homes were flooded on both coasts of the state. An exact death toll has not been confirmed. There's more pressure on the European Central Bank to keep raising interest rates aggressively. The Eurozone has just recorded its first ever reading of double-digit inflation. Consumer prices rose 10% in September from a year ago. That's the 5th straight month the inflation figure has exceeded the consensus estimate. Over in China, Bloomberg's learned that regulators have told the biggest state-run banks to provide $85 billion in financing to the embattled property sector. That's for the last months of 2022. A property slump has been weighing on China's economy for more than a year. In Brazil, President Jair Bolsonaro and former President Luiz Inácio Lula da Silva traded insults in their latest debate before Sunday's election. Bolsonaro called Lula a liar and an ex-convict. Lula accused Bolsonaro's government of corruption. He leads in the polls by a wide margin. Lula could win in the first round if he gets more than 50% of the votes. And shares of Nike, they are lower today. The sports shoe giant reported that inventory has surged, and it's had to push through discounts that have hurt profitability. Higher freight costs and markdowns and foreign exchange effects hurt Nike's gross margin in the latest quarter. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
If you see U.S. real rates rise to the extent they have and with the speed they have and the negative reaction to equities, at some point, it's hard to know when, but at some point, even the Fed blinks.
Based on the Fed speak of the last 24 hours, not yet. Dean Kernet, founder and CEO of Macro Risk Advisors, live from New York City this morning. Good morning. Equities bouncing back, and then they fade. Up just 1/10% on the S&P. On the NASDAQ, up not even 1/10%. Yields were lower. They're still lower on a 10-year by almost 10 basis points to 368.82. Euro weaker by 6 or 7/10%. Euro dollar 97.52. CPI out of the Eurozone today. Inflation, Tom, coming in hot, double-digit CPI. One ECB official from the executive board speaking right now saying there's a risk of expectations de-anchoring on inflation, Tom, and that means this ECB, in the minds of the ECB officials, has a lot more work to do.
How does that theory work with the Netherlands at inflation of 17.1%? And I know there's a set of yeah buts, John, but does theory work here, sort of like a 7 standard deviation move on the theory of a derivative strategy in a pension market?
How do you re-anchor inflation expectations, Tom, when you have massive financial stability concerns alongside that? We've seen that in the UK this week, and I would argue Italy, I'm not saying it's a red light, I'm saying it's amber. Starting to turn, Tom, starting to turn.
For John, Lisa, and I, and all of our team, we are going to continue to monitor this through the weekend as well, and it is across equities, bonds, currencies, and hydrocarbons given a war in Ukraine. Expert on this is Regina Mayer, Global Head of Energy at KPMG, which barely describes a nexus of her military experience with a study of hydrocarbons at Rice University. Regina, thank you so much for joining today. What are you watching in the oil and gas market? When you begin your day, what is the thing we need to focus on right now?
So when I'm thinking about what's happening in Europe, because that's where there's a lot of attention these days, I am looking at 3 things every day, Tom. That is, what is the natural gas stock supply look like? What are the spot and forward natural gas prices in Europe? And what do we think the weather projections will be both for today, tomorrow, and the coming winter? The near term, I'm near-term optimistic because European gas stocks are at 90% of normal for this time. They were at 50% over the summer. So I think the EU's done a great job of rebuilding that stock. Short-term prices are down 50% from their highs over the summer, though they're still 200% higher than they were this time last year, but they've halved by the summer. And I think we're hoping that the weather stays more in our favor. So near-term optimism, but those are some of the things I look at.
Near term, what about longer term?
Yeah. Well, longer term, there's so much volatility. If you just look at this week alone, Lisa, crude oil price jumped around 8 to 10% up and down. And so I think the market has a lot of jitters. We saw some downward price pressure with recessionary concerns and the strengthening of the dollar. But then we worried about demand because the market got jittery with what's happened with the Nord Stream pipelines, even though that actually does not affect near-term European gas supply because those pipelines were not serving Europe. But the EU has done a great job of reducing its short-term dependence on Russian gas. And so I think that the added threats will create upward price pressure. It will continue that, but the recessionary fears, the rampant inflation that y'all have been talking about, that creates a downward price pressure that keeps us more in balance. Some analysts are pegging average crude price for 2022 to be in the 70s, which I don't think I would have expected that just 3 months ago.
Well, sticking on the energy story in Europe, we heard from Anne-Marie Herdern, our correspondent in Washington, D.C., about how there are increasing calls from Europe for the U.S. to lower its natural gas prices as it exports to Europe, to give them some assistance through the winter. Do you see that as a realistic outcome, that the U.S. is willing to provide marginal demand and somehow cap prices in some manner?
I did think that was interesting in the paper that the EU has issued about creating an LNG transaction-based benchmark. The markets are very transparent, and hydrocarbons have been trading in the ways that they've been trading for almost decades, right? So I don't know how successful that will ultimately be, given all this volatility that we've been talking about. I do think, though, the governments are really interested in having more unified policies to protect their electorate and to secure energy supplies for the coming winter months.
Regina, the Netherlands was 17% inflation. In the hydrocarbon part of that, I believe, is 114%. Just unimaginable numbers. What are the ramifications if we get 90 days of 17% inflation in the Netherlands?
Well, I'm not an economist, Tom, but I mean, I think you're seeing major price escalation. I'm talking to a lot of senior executives that run manufacturing companies all across Europe, and their energy costs are through the roof. And that cost then has to get translated back down into goods and services that go to consumers. And that, I think, is what's driving some of these crazy inflationary numbers that we're seeing. And until we can drive that overall energy cost down, they're making short-term decisions to cut manufacturing runs as a demand management response. But I think we'll continue to see a lot of upward pressure on price given these higher energy costs.
Regina, thank you. And thanks for making it this morning to join us. We appreciate it. Regina Mayer there of KPMG. Tom, what this feeds is just this idea that maybe the peak for inflation in Europe is still in our future. Still in our future at a time we've been spending the whole summer talking about peak inflation being behind us in America.
And that's the uncertainty, and it's a litmus paper on a Friday morning, of global Wall Street. And John, you see it with Euro just giving way to morning weakness, sterling on the cusp of morning weakness, and very importantly, John, DXY vaults up where we begin to think about a revisit to 113. A plus 114 DXY, John, would be grim.
German yields coming in today. A little bit. In Italy, we're down 12 basis points, but Lisa, that's not been a story more recently over the last month or the last 12 months for that matter, has it? It's not been a story at all. To see double-digit CPI, I don't think we should let that slide. We've seen double-digit CPI in Germany this week, in the Eurozone more broadly.
10.9% in Germany, 10% across the Euro region at a time when they feel like they have to, I'm talking about policymakers, support households and give them some fiscal assistance heading into a winter. This is a deeply uncomfortable moment, and the shift that we have seen in yields. Someone asked me yesterday, why is the bond market more important than the stock market? And I went back to what you said, John, yesterday, which is when you have a problem, when you have the biggest risk in risk-free assets, that's when crises happen.
I thought the rant would have been a lot longer than that.
Well, it was. That was the
beginning. Did you deliver
just
a massive speech about why fixed income is more important? People in fixed income are so much smarter. I don't think you finished there.
No,
I don't think you finished there at all. Do you know the song that the bonds don't work, they just make things worse? You ever heard that song? It's my song, they're my lyrics.
Was that ABBA?
That was ABBA, Tom.
I thought so.
That was ABBA.
I got that right.
I think the actual song was the drugs don't work, they just make it. Anyway, the bonds don't work,
Really?
they just make
British humor,
things
Lisa. Go
worse.
with it.
And it's bond market humor. Just let me run with it. That's been the problem in this market. And at the moment, we're all talking about recession. bond market's not getting a bid in Treasuries. Sure, it's come down from 4 to 369, but given the recession we're talking about in America, high interest rates and all of the above, wouldn't you expect us to have maybe a 2-handle, a 1, and that's the world we're in?
Because of the sea change where you have central banks selling their assets, it's a difficult moment.
Totally, and with inflation where it is too. Jim Paulson's coming up of Luthold. Looking forward to that. This is Bloomberg.
Should we anticipate that you will have regulations clarifying what the SEC is going to do on cryptocurrencies and related kinds of things in the near future?
It's pretty clear that many of these tokens may be securities. What we've asked the trading platforms, the lending platforms, the other various venues to come in, to work with us, to get registered under the securities laws, because if a platform has 50 or some of them 500 tokens on their platform, probabilities are they're not all non-securities.
Now, there's another issue that has arisen, which is called gamification, which is to say people are making a game out of trying to buy stocks. Are you worried about this phenomenon?
We live in the 2020s in a new digital age where applications on our phones can use massive amount of data and then predict our behavior. What do we do when the digital algorithms are maximizing for the company's revenues rather than our returns? And so we're trying to think that through. It's not just gamification, it's a little bit more than that. It's whether there's a conflict between the app and our investment returns.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
If you're not really in this space full time, I think it's very hard to run a successful crypto fund.
If this financial dysfunction gets bad enough, the Fed is going to have to blink.
The blinking is probably going to start in 2023 when
the U.S. Fed cycle, essentially comes to an end.
Regardless of the dysfunction, they will continue to raise rates.
The tightening is going to have to be persistent, at least for the next 12 months.
We're optimistic that by the end of next year, the Fed's going to be much closer to where it wants to be without necessarily having to pull the economy into a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on an extraordinary Friday. I'm going to go with Contagion Friday. Here's what we're looking at. And, John, the contagion starts at 10 Downing Street and over at the Bank of England.
I'm very aware that my audience is far, far smarter than I am. So here's the update to the Verve lyrics. Because the swaps don't work, they just make things worse. But I know that we'll get bailed out again. Story of the market this week, Tom. Huge moves, and the Bank of England stepping in with a big gilt market operation. That's a Band-Aid, though, TCAM. We've talked about that a million times. It has an expiry. It's the middle of October. Let's see if that's when it expires.
There's so much insight here, folks, and so much reading for the weekend in this historic time. I don't want to derail the opening, John, right now. John, let's just go to what's happened in the last hour in London that affects global Wall Street.
They met with the Office of Budget Responsibility. There was a hope that maybe we'd get some independent forecasts to go along with this budget. The Prime Minister and the Chancellor walked away from that meeting. It doesn't look like we'll get those forecasts, Tom, until we get an update to the budget again in late November. So the timeline as follows, and I've gone through the dates a few times. I'll do it again. The 14th is when the operation for the Bank of England ends, set to end. November 3rd is when we get an MPC decision on monetary policy from the Bank of England. Then the end of November is when you get that full fiscal statement from this government, Tom, and that's quite a runway. 2 months is a long time in this market.
We're voting now in the foreign exchange market, week of sterling, and we'll get to that in the data check. But Lisa, we vote in the bond market, bills, notes, and bonds. Lisa, what have you observed in the last 24 hours?
Credit is softening. There is a different tone in the credit markets, and this is notable because for a while we had not seen that. You saw the biggest weekly outflow from top-rated corporate bonds in the United States ever on record, the third biggest, and you have an ongoing deterioration in the valuations at a time when companies are withdrawing bond sales. They do not want to be exposed to this market right now, and we're headed toward possibly one of the slowest months of bond sales for a decade, at least that is the Bank of America expectation. This matters. People have been saying, when's the bond market going to crack? When is credit going to crack? There are cracks. They're kind of forming, Tom.
On radio, a chart now with the derivative strategist, Jonathan Farrow. John, let's go there. This is a chart I did a couple days ago. I haven't seen it anywhere else in the world. This is a certitude of the second rate in the derivatives market, which Lawrence Summers in the last hours has mentioned. Only once, John, in 20 years did we go out to 2 standard deviations. John, this was a guaranteed sure thing in Mayfair.
And then it wasn't.
The green circle, folks, way up top is trend, comfortable. Let's have lunch at that Indian place. John, you like the Mayfair. And then down we go 4 standard deviations. That's where we get a little sweaty. And we are at 7 standard deviations, and the certitude drifts away.
Can I just say, Tom, Jamavar, my favorite Indian restaurant in Mayfair. Just throwing that out there just so everyone knows. And
that's very good.
Go and visit. It's a bit pricey. I understand.
I'm going to go with Lawrence Summers here, and it's not original to the great professor. Every time you see a derivatives blow up, there's little redounding moments out there. They're out there this Friday.
What this speaks to, Tom, and these pension funds in the UK were invested in these specialized investment funds. They had margin calls on trades. A lot of people had to basically sell some positions, but the most liquid positions they had were gilts. Sold gilts to raise cash to meet those margin calls, and of course, selling gilts just made the whole thing worse. So I go back to what I said at the start of the program. The bonds don't work, they just make things worse. And that is true of the story so far over the last couple of months. And at least it goes back to something you and I were talking about. The risk this year, it's not been in equities or credit. The risk this year has been in the risk-free asset. And that's something we're all struggling to get our hands around.
Especially because there are leveraged instruments that we haven't fully appreciated. At what point do you get margin calls?
Right.
And this, Tom, has been the concern because if those prices go down, you have to post more collateral. What do? You sell the risk-free asset. It creates that spiral.
Exactly. This is David Goldman 101 from Bank of America in August of 2007. John, on the data, let's be quick. Sterling to new weakness this morning, 112. 12 down to 110.38.
Euro as well, 97.53. Double-digit inflation in Germany this week. Double-digit CPI in the Eurozone this morning. Yields are lower elsewhere by 8 basis points, 370 on a 10-year. And equities just about holding on, Tom. Positive 0.25% on the S&P.
Holding on is the expertise of the chief investment strategist at Luthold, Jim Paulson, recalibrates into fourth quarter with us this morning. What's the value of cash right now, Mr. Paulson?
It's nice to see cash, Tom, at least giving a positive yield of some merit, but I don't think it's the right asset to be in right now. I think things are pretty unsustainable at the moment, and it's all tied to policy officials raising rates. In this country, the 10-year yield is going straight north while commodity prices are collapsing, while inflation surprise index is falling, while the ISM price surveys from service and manufacturers are falling out of bed, while inflation expectations in the bond market, break-even rates are collapsing. The dollar is simply out of control, and the upside is a reflection of yields. And I think, something's got to change. It's gotten too extreme, and probably what changes is rates stop going up soon. And if that's the case, I think the stock market's going to have a good rip yet, and I don't think you'll be pleased by putting too much in cash. But having some in cash, it's nice to have a bond market that's yielding something and a cash market that's yielding something. It certainly gives asset allocators or just people, individuals, an opportunity to diversify some risks that they haven't had for quite some time.
What's that call option you've got then, Jim, on a rip? What are you playing? Where are you sitting? What's the pocket of the market you want to be present in?
Well, I think I look at this like coming out of a recession, Jonathan. I would look at early cycle stocks. My favorite sector is the consumer discretionary sector. I think it's the one sector that's been most harmed by inflation. It destroys not only their operations by squeezing their margins of the companies, but it destroys the confidence of their customer base. And so as inflation rolls over, I think those stocks come back to life. I'd also, look at growth stocks, particularly small cap growth. My favorite tilt would be towards small caps, which, by the way, have held up remarkably well in this last draft in the stock market here since August. And I think that I would have some exposure there. I also think that there's cyclicals beyond the consumer discretionary that probably play, like industrials and so forth. And I also think there could be a play on the dollar yet. I just think the dollar's too high, has got to come down. And I don't know if I'd have a broad-based international bet right now, but I would maybe in emerging markets, excluding China.
So, Jim, right now, Nike shares down 11% in pre-market trading. A screaming buy?
No, I don't have any particular preference to Nike, Lisa.
I don't mean to put you on the spot. I know that you're viewing this from a more big picture sense, but I guess that the point that I was trying to make is what's the risk to the downside as you wait for the Fed to blink when the Fed's saying we're not going to blink, and no, things are not breaking. It looks like actually financial stability is holding in just fine in the U.S.
I think we're getting really close to a blink, and it'll probably be forced. It could be that we get a really weak economic report. It could be that we get a really good inflation report. Probably more likely is something breaks. And you guys are bringing up things this morning that are starting to show some cracks in the foundation. And right now, if something breaks in the U.S. and it's a systemic problem, there's more downside risk in the stock market. But I think that the private balance sheets of the United States, both households and corporations, are very solid, and they're very liquid. And the banking industry is squeaky clean in this country, and the chance of a systemic balance sheet break here, I think, are low. So I think something breaks, but if it's not systemic, it will cause a pause in the tightening cycle across the globe, and that could be a really big positive here for the stock market.
Jim, that's the bit I struggle with. Can you make that final point, and then I'll come back to you? Just take the stage. You've got the stage.
Okay, I just want to make one point that, Powell seems bent on, channeling his inner Volcker moment. And the entire Volcker moment that actually occurred in 80 to 81 there, when Paul Volcker took the funds rate from 9.5% in August, I think, to 20% by December. The stock market after that, 81, 82, fell by a total of 27%. And I think it's important to recognize we're already down 25% in this country already. So even if we're having a Powell moment, you know, it's interesting. Volcker had a Volcker moment after 15 years of runaway inflation in this country. The Powell Fed is wanting to do a Volcker moment after 15 months of high inflation. I don't think the two are comparable and don't need the same approach.
Hey, Jim, we'll continue this conversation another time. So we appreciate your thoughts. Incredibly constructive. The hope is there. Jim Paulson there of the Luthold Group. The issue that many people have with that view is, Tom, why is it bullish if the Fed stops because of financial stability concerns or a recession? Why is that bullish? And there is a difference between a Fed pause and the Fed cutting. Now, if you're going to tell me the Fed will pause, I think the right way to frame that is you're basically telling me the Fed's not going to be cutting interest rates in a recession. So the Fed's not cutting in a recession. Is that bullish?
It's original, is the word I would put. John, I'll say it as simply as I can. What always ends up happening is you impute permanent inflation and price change into the economy, and that's a price the middle class pays.
Futures right now.
The fancy people are protected.
Up a third of 1% on the S&P. Yields lower by 8 basis points from New York City. On radio, on TV, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Hurricane Ian is taking aim at South Carolina. Storm's winds picked up to 85 miles an hour overnight, and it's expected to make landfall today north of the historic city of Charleston. Ian caused catastrophic damage in Florida, where it came ashore as one of the strongest hurricanes ever to hit the U.S. The storm flooded towns on both coasts and wiped out entire neighborhoods. An unknown number of people are still believed to be trapped in their homes. British Prime Minister Liz Truss won't change course on the government's unfunded tax cuts. That's following talks with the government's budget watchdog after a week of market turmoil. Bloomberg's learned that Chancellor Kwasi Kwarteng will stick to his plan of delivering a medium-term fiscal statement on November 23rd. In Brussels, European Union energy ministers have backed a package of measures to fix the natural gas crisis. They include a goal to reduce power consumption and agreeing to tap windfall profits of energy companies. Still, there's some frustration that more hasn't been done. Vladimir Putin is set today to annex parts of Ukraine that Russian troops control. And that's after a referendum condemned by the United Nations and called a sham by President Biden. Russia plans to sign treaties to absorb the 4 Ukrainian regions. China has formally certified its homegrown aircraft to take on Boeing and Airbus. Certification for the C919 would typically mark the end of flight testing and paves the way for a plane maker to start deliveries. For now, the C919 will only be allowed to fly within China until it's certified by foreign regulators. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It's the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leni Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg. No one covers the world like Bloomberg.
Russia will then absorb these territories. What is NATO's reaction?
Italy's Giorgia Meloni wins a clear majority, ushering in the nation's most right-wing government since World War II.
The Fed offers no sign that it is ready to stop tightening.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
If you look at the dots, it does look like the committee is expecting a fair amount of additional moves this year. I think that was digested by markets and does seem to be the right interpretation.
Another way you could put that is that the Federal Reserve just endorsed the sell-off of the equity market. That was Jim Bullard, the St. Louis Fed president, speaking at an event hosted by HSBC. President Mester spoke yesterday as well, Lisa, asked if a recession would change her plans to hike interest rates, and she essentially answered that question with no.
That seems to be the message pretty clearly across the board. Citigroup put this out this morning. We still think a soft landing looks unlikely in the U.S. Thus, the Fed will have to tighten conditions enough to lower the equity market. The Fed is basically confirming that view and saying that is part of it, and they are not backing away from a slowdown that it may cause.
That's the objective, for now at least. On the equity market, we're positive 0.25% on the S&P. On the Nasdaq 100, up around about a third. Yield still lower by 8 basis points, Tom. 3.7% is your yield on a 10-year.
Amid a large crowd, I believe, in Moscow, history in the making. This is Mr. Putin just walking through large gold doors, and he is speaking to the assembled on the annexation of Ukraine. An expert for us with great experience on this across the continent, Anne-Marie Horton from Washington this morning. Anne-Marie, Mr. Putin is selling this to the Russian people. Who's behind him on this? Is this the military behind him? Is it the quote-unquote far right? Or is it a nostalgia for a new Soviet Union?
It's him. He's behind this. He's making all of these decisions as he stands in the Kremlin at St. George's Hall there. You can see he's surrounded by Russian officials and his government, legislators in the Duma. But this is all Putin. This is something he had dreamed of doing. Many thought he would never do this, only because of the repercussions and the blowback the Russian economy would face, and especially given the fact that they spent 20 years trying to integrate themselves into the global financial markets. And he then went for it. And like he did in 2014, the annexation, he is doing it with these 4 regions. And we should note what Putin is laying claim to today in this speech right now is 15% of land in Ukraine. That is the biggest laying claim of occupation of land that we have seen since World War II. And the biggest question right now surrounding all of this is if Putin is selling this to the Russian people at the same time that independent polls are saying the mobilization effort is not working. These men do not want to go fight this war. You see a mass exodus of these reservists. But at the same time, the biggest question right now is if he is laying claim to these lands, does he mean that if they are attacked, which there's fighting right now in them, will he revert to using tactical nuclear weapons?
For those on radio, as Mr. Putin speaks, of course, the images of leaders of his operative cabinet, including Mr. Lavrov moments ago. Amory Horton, I look at where we are with Mr. Putin, and we must say, what is the response? It has echoes of 1938 and 1939. We learned lessons there. What can be the response of Secretary Blinken and the president?
Well, we already heard the president ask about this late last night, about these sham referendums, and he said, I want to make clear, the United States will never, and I think he repeated it 4 or 5 times, never, ever, ever, ever say that this is Russian territory. So you're going to hear a ton of that kind of rhetoric today, whether or not it's from the president. His national security advisor, Jake Sullivan, will be in the briefing room today. All the questions are going to be about this moment, what is happening right now in Russia and this land grab in Ukraine. And of course from the Secretary of State, but they made it obviously very clear also that if Putin was to go into his nuclear arsenal, there would be consequences. But there is angst around the European countries, especially those that share a border with Russia. You think of Poland, and what they're concerned about is not even so much if Putin goes and uses nuclear weapons, but if there is an accident at, say, Zaporizhia, the biggest nuclear power plant in Europe, what does that mean for the areas surrounding Ukraine? And these countries are incredibly, incredibly nervous.
And Marie, we've talked a lot about what people within Russia feel as this goes on, and it's gotten more fraught at this moment, especially with the conscription, or at least the calling up of reserve forces. Do you have any sense of what the pushback is like internally, of whether people are starting to say, this is going far awry?
Well, there is pushback. There are protests that happen, and then these people get dragged off to jail. And then you've seen this mass exodus, a brain drain, and also a drain of men that are of fighting age leaving the country. You saw an absolute spike in Google searches of how to get out of Russia. You're hearing stories of people just grabbing any last flight they possibly can. They're walking across borders over Estonia and into any place that is going to offer them refuge because they do not want to get that knock on the door. And you're also seeing this a huge issue in countries like Georgia and Kazakhstan because they're having these buildup on their borders of people trying to leave. So in terms of morale of this mobilization, it is not there. And part of the reason is because Putin just months ago promised the Russian people there would be no conscription. And then yet once again, he's lied.
AMH, you're in a class of your own. We're lucky to have you. Thanks for being with us. Anne-Marie Horton there, down in Washington, D.C. Russia's leader saying the documents on annexation, Tom, will be signed today as we wait for that speech to begin and the headlines that will come from it.
I talked, John, of a 2022. As I mentioned at the top of the show, I ran into Gideon Rose yesterday, and, you know, in laughter, I blamed him for this 2022. But this international relations, John, is moving in real time. And I don't have any punditry to add to it other than we need to apply our acutest minds to it across many fronts.
As Europe grapples with an energy crisis, at least with no end in sight. We're talking about this winter. We're talking much more now, I think, and Jeff Curry said it, about the winter after that and the one after that.
And I wonder how much the U.S. can really step up and provide them with what they're looking for, or Norway. I mean, where are the other sources going to come from? Post-2022, there is going to be a complete rearranging of the energy dominance, really, of the nations that really have the clout in the energy sphere, and it's unclear what it's going to look like. But Russia apparently seems to be excluded from that, and not just with respect to oil and gas, but also with respect even to steel and some of the other commodities as people try to figure out how to get around turning to them.
Coming up on this program, Tom Porcelli, the chief U.S. economist at RBC Capital Markets, and his latest note, his daily check. There is a saying in economics that we live in a nominal world. That may be true, but economics is graded in real terms. Tom Porcelli is going to be joining us very, very shortly. Equities up 0.2% on the S&P. On the Nasdaq, Tom, up 0.2% as well.
Is Porcelli doing the real yield this afternoon?
He doesn't know yet. He's joining with Laurie Calvasina. They're both going to join me. We're doing an RBC special. Halima Croft dropping by too. None of the people at RBC know about this.
They're going to do it alone. They're just going to come on and they're going to come on and do it themselves.
Lisa doesn't know she's hosting it. Tom doesn't know he's on it. From New York.
Great.
This is Bloomberg.
make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
You will put a woman on Mars. You will bring forth global cooling. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
Live from New York City this morning. Good morning. Fascinating headlines coming out of Russia at the moment. The Russian leader signing documents on annexation today, going on to say this: the collapse of the Soviet Union was a national catastrophe. We've heard that from Putin earlier this year. Russia is not seeking to restore the Soviet Union, calling on Ukraine to stop fighting and start talks. Won't discuss the results of the referendums with Kyiv. Will defend our lands with all available means. Russia won't negotiate about annexed territories. That line, Tom, I wonder how that's going to be received by the Ukrainians a little bit later.
I saw a headline earlier this week, and the Ukrainian take, and I'm making this up as I go, folks, was they won't negotiate with Mr. Putin. They want to see somebody else to talk to. Well, that was a number of days ago, which, John, is forever ago. But I would just respectfully suggest this is history in the making. We're seeing right now, I believe Ms. Horton said this is 11%, 18% of territory.
Shocking, just shocking, Tom. Yeah. Just like that. I want to get you some data as well. The PCE deflator month on month comes in hotter, 0.3% for August. Year over year, 6.2. We were looking for 6% year over year, month on month. Lisa, we were looking for 0.1. I'll bring the core to the audience as well. PCE core in at 0.6. Up from 0.1, that's month over month. Year over year, 4.9 year over year. That's up from a revised number of 4.7. Your thoughts, Bramo?
Exactly what the Fed does not want to see, kind of like the unemployment numbers yesterday, which are good for the economy, but bad for the Fed because it's moving away from them. Basically, you're seeing a stickiness in the core inflation metric that they watch most closely. And you can see that the reaction is downward when it comes to stocks and bond yields ticking up just a little bit on the front end. But you've got to wonder how much this really does challenge people who think the Fed can afford to pause, can afford to say, we're going to see the weakness trickle through, because you're not seeing that when you take a look at the core inflation data.
The conflict in policy, and well said, Lisa, this week is just humongous. They're chasing their tails, emboldened by a lagging indicator in the labour market. Claims are still sub 200K. Tom, inflation's still hot, and financial stability risk is bubbling away in the background, to the point that the Bank of England had to intervene earlier this week.
Yeah, well, that's a derivative story that's unfolding this weekend, and I would look for every single responsible general counsel to say, John, let's get the news out right now, worldwide, on the continent, in the United States, anybody doing this LDI derivatives strategy as well. Let's march forward here. We've got an extremely busy, important half hour. John, what's your number one guest in the next hour? Let's sell the 9 a.m.
Mohammed Al-Arian, top of the show.
He's going to show up again.
In
Wonderful.
the A block. Going to catch up with Mohammed. We'll catch up with Matt Hornback as well. Going to catch up with Jill Carey Hall of B of A, Julian Emmanuel of Evercore.
Julian.
Got more guests. Going to keep going through them.
As well.
I haven't. That's it.
Al-Arian never wants to talk to me. I don't know what that's about. I mean, it has, I insulted Queens Park Rangers one time.
And that was it.
That was it.
That was it.
Right now, Thomas Purcelli with us, chief U.S. economist. Again, Matthew, please. Okay, we've got a technical difficulty here right now with Mr. Purcelli. John, I was going to go to Mr. Purcelli's wheelhouse, which is wage analysis among an America with claims of under 220,000 as well. You wonder what wage dynamics do here amid slow productivity.
I can give you a tease of Tom Purcelli if you like, and I'll just read you his latest note. So I read the first couple of lines.
Oh, you read his notes. I didn't read his notes.
I read the note. There is a saying in economics that we live in a nominal world. That may be true, but economics is graded in real terms, meaning inflation adjusted. The next line, Lisa, reads as follows. What we know right now is that the volume of goods in spending, i.e. in real terms, has been and continues sinking.
Well, and this is what some people have been saying, that you are seeing people spend on services, but that's the reason why you're seeing the likes of Nike, for example, or many other companies seeing inventories build because people are not spending. And he is basically making the argument, as are other people, you're seeing a lot more softening, and this was Jim Pulse's argument, the Fed doesn't have to be as aggressive. It will take hold. You will see a natural effect kind of play into it if Tom say you expand out the x-axis. Still, though, what's the other side of that? Especially, these are uncharted territories.
I think the point that people are asking right now is that the labour market, the headline indicators, jobless claims, all of the above, still look rock solid. And if the Fed is waiting for that to break before they back off, do they risk waiting too long? What Purcelli ultimately ends up saying is that we have said that job losses, when they materialise, are likely to be relatively modest. But what if earnings get really dinged up here on the fact that the volume of spending, Tom, is declining and maybe gets worse as central banks around the world slam on the brakes? It seems pretty clear that net value add would just get worse from here. That's the conclusion, Tom, from Tom and the team at RBC.
An event as we move into the fourth quarter this year, an attempt to recalibrate. Tom Purcelli now joins us with RBC Capital Markets. It's the oddest thing, Tom. This wasn't in the textbooks at Binghamton. It wasn't in the textbooks at Columbia. How do we have this tumult and yet claims showing a fully employed America?
So let me first start by saying, Jonathan, honestly, like I'm happy just to sit by and listen to you speak my words. Like they sound beautiful.
That's the act.
You.
I can do the podcast, Tom, if you want to hire me. I do the podcast. You have to pay me by the word.
And I can do that. I mean, I don't know who wouldn't do that for you. And I will also say to you, Jonathan, I am waiting for my invite to the Real You.
We've got to make that happen, Tom.
I love that Lori's going to be on. She's one of my favorites. So one day I'm just going to be waiting here for that invite.
You can take the call anytime. Tom, the point that you're making, though, I think is a really important one. So allow me to reframe it from my perspective. Are you essentially saying that this Fed's going to be emboldened by labour market data that's not going to move too much and they just risk going too far?
Yeah, I think that's exactly what's happening. I mean, look, we all get the sort of. Don't you guys find it interesting that when people talk about the labor market and how robust they think it is, they always default back to the payroll report, right? When most other labor data have deteriorated, even jobless claims. Look, I get it. It's great that they've scaled back. They're still up off the lows. They're up, what, 20% off the lows? I mean, the movement is what matters. Even if you look at something like the labor differential, from the conference board, I mean, that has deteriorated. And by the way, the proof in the pudding on that is just look at average weekly earnings. I've said this to you all before. It's slowing. It's starting the process of slowing. You were running at a near 7% pace. Now you're at 3.5% pace. I mean, there are indications that the labor market is starting the process of deteriorating, and seemingly on a pretty regular basis, we get companies that say they're either freezing hiring or they're going to start laying people off. And the point of that note, Jonathan, that I put out the other day was exactly this. It's, at some point, companies are going to. So if you look at profits, right, profits in real terms, I mean, it's funny to me that people have a hard time with this. I don't know why. Profits in real terms are flat. And nominally, they're running at a 13 or 15% pace, and I guess people take some comfort in that. But adjusted for inflation, they're flat. And if we're right that the volume of spending continues to slow, and actually, let me be clear, not even slow, it's falling. What do you think is going to happen to earnings? And when that shows up, if profits are already flat and earnings and the volume of spending is down, that means we know the direction that profits are going. How do you think companies are going to defend profit margins? That's all waiting for us. So, the Fed can continue to look at the landscape today and say, hey, we feel really comfortable raising rates, but it's deteriorating now.
Tom,
sorry, Lisa.
No, I appreciate what you're saying, and you're talking about how the labor market's a lagging indicator, or might not even show the pain to the degree that other aspects of the market. But it doesn't feel like the Fed is really paying attention to earnings. They're not paying attention to certain stock market metrics, except to the fact that they perhaps would like to see the stock market go down. If you look at some of the members of the Federal Reserve, however, they are looking at inflation. Can you see a case where inflation is still high, the employment market is not showing a real deterioration, but you could still make an argument that the Fed should pause or even lower rates?
Yeah, so I love this question, Lisa, and I think what we need to, it's fun. On some level, I was just talking to a buddy about this the other day, like on some level, I would love for like Powell or someone to come out and say, hey, we're just cleaning up the mess made by fiscal policy, right? I mean, because that's a really important idea in that, why did we generate this inflationary impulse, right? I mean, at a base level, we shut down a really healthy economy, we gave people a lot of money, creating a pent-up demand scenario. We then turned the economy back on like a light switch, and we dared these people to go spend, all in the context of supply problems. I mean, what did we think was going to happen from an inflation perspective? But here's the thing. Once we burn off a lot of that pent-up demand, and once we burn off a lot of that fiscal stimulus that was put in place, and you have this deteriorating labor market that we were just talking about, it's really easy to see a case where inflationary pressure can actually start the process of easing, and that's what we expect will happen in 23.
Tom Purcelli with a big call at the end there from RBC. Tom, we're going to continue this conversation another time. Tom Porcelli there on the latest. Lisa, interesting thoughts, eh? It's something that's been talked about a fair bit, that maybe they are emboldened by a lagging indicator that ultimately is not going to leave too much pace. Here's the question I would ask, and someone smarter than me said it yesterday. You can't fire what you can't hire. And a big struggle over the last couple of years has been hiring enough people. So what have we seen from the big tech players, the likes of Facebook, Meta, if you want to use that word? They're freezing hiring. They couldn't meet the headcount anyway because they couldn't find the people, and so many people are in that place. So I wonder what this labour market downturn, if we get one, actually looks like.
It's a great point, and you're seeing this also with the likes of Amazon.com raising salaries to keep attracting people, even though things are slowing, right? So there is this divergence between what a fully employed America looks like and what a fully employed corporate America looks like, and the prospect of a downturn. At the same time, let's be clear, the Fed is not just looking at the employment market. They are also looking at inflation. And if inflation remains high, it is very hard to make an argument that they can keep their foot off the brakes to try to really fight it.
Coming up in the next hour, we'll have this conversation with Mohammed Al-Arian of Queen's College, Cambridge, Jill Carey-Hall of Bank of America, Matt Hornbeck of Morgan Stanley, Julian Emanuel Evercore, and Marco Kolanovic will not take my call. Marco just won't take my call. Going to keep trying.
Stick him in there.
And trying. He doesn't know he's coming on later. He's not.
He's earning a real yield.
He's not. Futures unchanged on the S&P from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Hurricane Ian's winds have picked up speed and the storm's on a path to hit South Carolina. The forecast calls for Ian to come ashore north of Charleston today with heavy rain and a potentially deadly storm surge. Florida is struggling to recover after Ian made landfall as one of the strongest hurricanes ever in the U.S. Entire communities were wiped out and homes were flooded on both coasts of the state. An exact death toll has not been confirmed. Vladimir Putin is speaking on the annexation of parts of Ukraine that Russian troops control. He says he won't negotiate the annexed territories, and he called on Ukraine to stop fighting and start peace talks. Russia held referendums in the 4 regions being annexed. Those votes were condemned by the UN and called a sham by President Biden. There's more pressure on the European Central Bank to keep raising interest rates aggressively. The Eurozone has just recorded its first ever reading of double-digit inflation. Consumer prices rose 10% in September from a year ago. That's the 5th straight month that the inflation figure has exceeded the consensus estimate. And new car sales in the U.S. are expected to rise in the 3rd quarter, but a deteriorating market for used cars suggests there's trouble ahead for automakers. The resale market often indicates where new car demand is headed, and used car giant CarMax says vehicle sales dropped 10% in the 3 months that ended in August. And shares of Nike, they're lower today. The sports shoe giant reported that inventory has surged, and it's hard to push through discounts that have hurt profitability. Higher freight costs, markdowns, and foreign exchange effects hurt Nike's gross margin in the last quarter. Well, global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
When you've had your fill of IPOs, ETFs, and CPI,
tune into the lineup for some NFL, NBA, and MLB.
catch the lineup right here on Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
These price caps are going to reduce inflation. This is an illusion, right? Because what these things do is they increase the demand for energy and therefore increase wholesale prices, and somebody is eventually going to have to pay for that.
The dynamics of Christian Schulz, city deputy chief economist, as Vladimir Putin continues his discussion in Moscow on the annexation of the Ukraine, of course, folding into hydrocarbon analysis. West Texas trying to get to a 79, 80.74, Brent flat, 88.60. We began our show this morning with a blistering conversation with a representative of the Trust government. Thank you for your comments worldwide, and particularly from the United Kingdom. Now, Lisa Bramowitz and I close out with someone expert on derivative certitude and derivative damage, Marcus Ashworth, with decades of experience like me in this. Marcus, I want to go to Nomura and Hyman's Nicholson in 2018. They absolutely nailed this. They called it peak LDI. Pension funds have been adding $100 gajillion of all-in derivative exposure a year. Given the high level of hedging, the current pace of rate hedging can only continue for at least another 3 years. We are approaching peak LDI. We know this. You knew this at Manchester in economics 1 million years ago, Marcus. I know it. We experienced it in 07, 08. Why are we screwing up derivative certitude once again?
Well, there's just direction of travel from the regulators is the simple answer. It's not fair on the regulator, maybe, but certainly both pension trustees, indeed now poor pensioners, are feeling the pressure of the way the actuarial rules work in the UK, forcing pension funds essentially to take ever more fixed income protection if rates go down. The irony is that if interest rates rise, if yields rise slowly and calmly, That means there's less requirement to own bonds because they can make up whatever their pension liability is going to be much better. The point is, it was a too sharp a move. This crisis is largely over. It's a very nasty moment. The Bank of England stepped in, solved it. They're going to continue to be around for the next 2 weeks. If you actually look at the take-up of what's coming through, it's only about 2.5 billion so far. This is not the 65 billion number getting floated around. That's the maximum. It won't be anything like that. I think what we need to do is maybe sort out the over-leverage, particularly into the LDI system.
Yeah.
The system itself can work, but not to the extremities and the leverage which they've been putting it through.
And Lisa, that harkens to 1998, the dreaded L word, and it's not liability, it's leverage.
And that's where I wanted to go, this question of full faith and credit, risk-free assets being pledged as collateral and then suddenly not being risk-free and being the epicenter of losses and forcing sales of risk-free assets to post more collateral, creating that spiral. Are there any other places in the financial system away from the United Kingdom where that looks like it could become a problem should the losses in the bond market become severe or sudden enough?
I mean, absolutely. I mean, I think Germany has already moved, as has Austria, to essentially repo squeeze and make it very difficult to borrow bunds. And that is essentially what's happened in the UK. The reason why we're seeing a recovery in the gilt market in the last couple of days, and quite a strong one, is because ironically, the repo system has tightened up. You can't borrow gilts to short. So, you know, beware of perhaps a little bit of settling. Next week, when we get, into the new quarter, a new month and what have you, there may be a second go at this. But the Bank of England's there for the next couple of weeks. It should be fine. I think people understand that the immediate crisis is over, but we do have a longer-term problem about exposure with that. But yes, there's a real problem to the U.S. Treasury market. In any swap counterparty which has post collateral, they can't borrow risk-free assets. It's very difficult. And that's something which we have to have a careful look at, both in Europe and very much in the US as well.
Meanwhile, there's a more traditional leverage that is of growing concern as well, which is companies that have borrowed money and need to refinance and find themselves either locked out of a market or prohibitively expensive to refinance. You're seeing that in Europe even more than in the United States. How concerned are you about the rise of credit risk perceived and the inability to refinance in certain pockets in Europe?
Well, what can I say? They've had 2 long years to drink heavily at the trough of free money, often negative money, certainly for governments and even for the odd corporate. If they haven't got their financing in order by now, then they shouldn't be in business. And that's the problem. A lot of these companies, if they are going to bang, they shouldn't have been in business in the first place. There needs to be a bit of credit destruction. But I don't see a major problem in defaults in Europe either. I don't think there's a huge issue here. It will get tight for some. There will be some liquidity issues, as there always is and there always should be. What we've got to move away from is the zero rate mentality and nothing can ever go bust. Because long term, that's what's causing a much bigger problem, which could go bang, as we can see with the sensitivity in derivative markets. The plumbing can get bunged up real quick, and yes, it will squeeze a few people trying to get mortgages, or the odd corporate who's got its financing schedule slightly out of whack. But look, if they need to borrow, they have to pay up. That's the market.
I got 8 ways to go here. Marcus Ashworth, brilliant as always. Thank you so much with Bloomberg Opinion and writing on his disunited kingdom. Lisa, literally, I got 14 ways to go to close out the hour. And what I would suggest is, boy, we have a lot of data next week. I mean, we're going to be, where are we a week from this moment? At 8:53, 20 minutes after the jobs report.
We got 2 data points this week, and we got 2 data points that both point to saying the Fed has more work to do. It's not the message that they want to hear. We saw jobless claims that came in lower than expected. We saw a core PCE deflator, a key inflation metric, come in hotter than expected. Both of these seeming to signal there are some problems here, and Fed speakers coming out and saying a slowdown won't cut it. And this goes to the Tom Porcelli point. They want labor market destruction to some degree, and they want to see inflation come down. They're not seeing either of those things, which really poses a huge problem for them.
It's just fascinating the moment we're in at the end of this third quarter, and I can tell you I did not expect this at the end of the second quarter as well. On the derivative mess, Lisa, is just something we have to read about. I went back and looked at YouTube videos of marketing efforts for liability-driven swaps trades from 2 years ago, 4 years ago, 5 years ago, and they're charming in their marketing certitude. I mean, this is a huge, embarrassing story, again, for the derivative business. Once again, take Buffett. The water went out and a few people aren't wearing swimsuits.
And it's the conundrum when you have risk and risk-free assets, when suddenly the instruments you've posted as collateral are the same instruments that you have to sell to raise more collateral, creating a price spiral in one of the main mechanisms of the global financial markets.
Major shout out to Team Surveillance this weekend, who day after day blew up the show to give you the best voices we can on the American ramifications of what's going on in the United Kingdom, with futures up 7. And, febrile seems to be the word of the week. I'll go with it. There's just a churn to the market right now. Sterling with a little bit of a lift, 110.74. Please stay with us through this historic day, including reports on Mr. Putin and Russia. This is Bloomberg. Good morning.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
Such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
If you're not really in this space full time, I think it's very hard to run a successful crypto fund.
We are heading towards another quarterly loss. Live from New York City this morning. Good morning, good morning. Your equity market trying to squeeze out some gains. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
We begin with the big issue, wrapping up a messy Q3.
The third quarter, there's been no place to hide. Stocks keep going down. It's painful and horrible.
We have had 10-year Treasury yields break 4%.
Global markets moving 20, 30, 50 basis points off of one data point or one policy announcement.
Whether it's fixed income, equities, commodities, currencies.
Everywhere is a pain trade at the moment.
The rates seem to be driving the bus.
That is driving sentiment. That is driving equity markets.
The dollar's a challenge. In addition to this surge in real rates,
it's been a pretty volatile time. There's really no case for equities.
We're bracing for some pre-announcements and earnings cuts. This is a hard market, so we'll see.
Joining us now is Mohammed Al-Erin of Bloomberg Opinion and Queen's College, Cambridge. Mohammed, allow me to bring you some headlines from the Fed Vice Chair, Lael Brainerd, saying the following. We should consider spillovers as rates tighten globally. Goes on to say the Fed policy needs to be restrictive for some time and that the Fed is committed to avoid pulling back prematurely. Mohammed, your thoughts on those headlines this morning?
John, they highlight this tension we're seeing within the UK now between the US and the rest of the world, which is how do you reconcile the need to tighten monetary policy with the need to maintain financial stability? And that tension is playing out not just at the domestic level, but at the international level.
Mohammed, you framed it perfectly earlier this week. Can you address inflation and preserve financial stability simultaneously? Does something have to give?
Not at the domestic level. If you're well coordinated at the domestic level, which is a big if, but if you're well coordinated, you should be able to reconcile it. At the global level, it's a real problem. John, you know, it's really important to step back and ask yourself, what has this week told us? It's been very sobering and we all feel exhausted. But we learned a lot. We learned that you can get a major policy slippage in the G7 countries with mature institutions. We've learned that liquidity can evaporate in mature markets just like that. We've learned that the most boring element of the non-banks can be a systemic risk. We've learned today inflation is still a problem in Europe and the US. And the last issue is what you just raised, this tension between monetary policy and financial stability. You know, we need to absorb this. I think this week has told us a lot about where all these transitions going on, and suggests that the next few weeks are going to be pretty volatile.
Mohammed, allow me to step back even further and go back to something you said maybe 6 to 9 months ago. You said it might be a choice between recession or high inflation for longer. Is it now a choice between recession and financial instability or higher inflation for longer?
So that's an important addition. I think for certain countries, especially those who are importing the U.S. monetary policy but do not have anywhere near the robustness of the U.S., that's a real issue. Yeah, and we've got to somehow figure out how to go through this. John, you and I know that we tend to focus on interest rate risk, particularly what the Fed's going to do, and on credit risk, economic conditions, etc. We tend to ignore liquidity risk, and that is something that we need to pay a lot more attention to.
Well, we've been paying attention to that in the UK in a major way this week. Mohammed, we've seen the Bank of England driven to intervene at the long end of the gilt market. We saw the BOJ in the last week have to come in and step into the FX market, support the Japanese yen. The ECB, before any of this, had to set up an instrument to get ready to put a lid on Italian yields as they set to raise rates even further. China's been warning investors that they're willing to step in. Mohammed, we talked about this earlier this week. Who's next? Who's willing to blink? And can we get to that equilibrium, that new equilibrium, without central bank intervention every step of the way?
That's the major question. And these interventions, to be clear, are temporary. I think you used the word Band-Aid. We call it plaster here in John, but you know, these are just Band-Aids. And it tells you that the global economy is not clearing on its own. Or if it's allowed to clear on its own, there's going to be a lot of collateral damage. You know my view, when you distort an economy for so long, getting out of the distortion is by definition problematic. And that is what we're learning. But we have no choice to get out of the distortion, because if we don't, the inflation issue is going to be even more problematic. I think you and I have been warning people, all of you who are looking for a pivot, be careful what you wish for, because this pivot only happens if you have an economic accident or financial accident. And the journey to an economic and financial accident is a very painful journey.
Two things, Mohammed. One, I've lived here too long. It's Band-Aid now and not plaster. It's like a role reversal with you in England and me here in New York. Two, I remember when I pushed you for a conclusion, you said the risk might be we might have to accept inflation for longer. Do you sense that shifting now somewhat, Mohammed? Are you focused more on the pain that we've got to go through to get inflation lower?
Not yet, John. Not yet. We're not there yet. I think we need to, central banks need to experience a lot more pain in order for them to settle for a significantly higher inflation target. Remember, that would be a significant blow to central bank credibility. And central bank credibility is not strong right now. So it will, unfortunately, I say this unfortunately because these are livelihoods at stake. Unfortunately, it's has to be more pain before we get to a world in which central banks say we are changing our inflation target. Now, you can justify changing the inflation target because the economy is going through such structural change that you need more lubrication in the system. So there is a justification for changing your inflation target, an economic justification, but the credibility blow would be significant.
Let's just stay on credibility this week. Was this week a blow for central bank credibility at the Bank of England? And allow me to frame why, Mohammed. The concept of fiscal dominance has become much more prominent this week in conversations I've had. Just the idea that the Bank of England will have to spend too much time supporting what the government is doing, that it will take its eye off the ball when it comes to its mandate. Do you think they've contributed to that perceived fiscal dominance this week, just by the way they've been very close to what the government has been up to, what the Bank of England has been up to through much of the last few days?
So I've had that argument, John, and honestly, I don't understand it. The dramatic 11 a.m. intervention was a financial stability intervention. We came this close to a financial accident in the UK, and that financial accident would have caused a general deleveraging of balance sheet and massive contagion in the financial markets. So the fact that the Bank of England intervened in the middle of a trading session, you know and I know they prefer waiting for a weekend when they can explain everything, or wait till after trading hours so they can explain. They just acted in a very bold fashion because there was a financial stability crisis facing them. That is what that was. This wasn't about fiscal dominance. This was about cleaning up or avoiding further damage to livelihoods. So I don't understand that criticism of the Bank of England, to tell you the truth. Now, where we're going to have a discussion is come November 3rd, have they acted in intra-meeting or not? As you know, I think they should. And if they haven't, do they have the courage to do 100 to 125 basis points on November 3rd? Then we will test that hypothesis.
I wonder if we had that conversation before then, Mohammed. How much of a cliff edge is there on October 14th when that special guild operation is set to expire?
They can extend it. I think that is a very soft deadline. They can extend it. They have to worry about what they're doing to the curve. Again, something that more people should be focusing on, because they are distorting the curve. But they can extend it, John.
Do you think they will extend it?
Depends what the government does. You know, this morning, early morning in the UK, there was a lot of optimism that the meeting with the Office of Budgetary Responsibility would be the context for revisiting just one element of the package. You know, to be clear, what's being questioned is not the structural reforms. What's being questioned is not the energy stabilization. It is just the magnitude, timing, and sequencing of these large tax cuts. And the hope was that this meeting with the OBR would provide the context, as you know, to just say we're gonna do that later. Well, it didn't happen. So that puts the rest of the policymaking community in a really difficult situation.
Mohammed, you've said 125 from the ECB, from the Bank of England rather, potentially on November 3rd. I squeezed this question in earlier this week. Given how things have played out over the last couple of days, do you think they can wait until November 3rd?
I don't. I understand that caution, John. This is all judgment.
Sure.
Type 1, type 2 error. I understand that caution. And there's also, you don't want the spotlight to shine on you, especially given what's happening to the mortgage market. There's a lot of pain in the mortgage market right now. People who simply can't get mortgages. Products have been withdrawn. It's a total mess. So I can understand why they would rather be cautious on that. But I do think that the longer they wait, the more they're going to have to do.
One final question, and this is a big call, and it's kind of crystal ball type stuff. I just want to understand your feel for things right now. Do you think by the time we start 2023, do you think this Federal Reserve is still doing QT?
That's a great question. That's a great question. I suspect they probably will be, but I don't have a high level of conviction on that call.
That's the one I'm trying to look out for. Mohammed, you've been phenomenal this week. Thanks for being with us. We really appreciate it. Good friend of mine, good friend of this program, Mohammed Al-Arian, and what's been happening in the UK and for global central banks as well. Keeping up with this market, I've said it all morning, all week, all month. You've still got another quarter of this, less than 7 hours remaining at a messy third quarter, and then you've got another 3 months. Katie Lyons has more. Hey, Kaylee.
Hey, John. Yeah, I can't decide if I feel like the third quarter lasted 5 minutes or 5 years because so much has happened. Where we are looking like we're going to end at the end of the quarter is down on the S&P 500 for a third quarter in a row. That is the longest streak of quarterly losses going back to 2009, with the losses this quarter to the tune of more than 3%. At the same time, we've seen massive moves in the bond market, up more than 100 basis points on the 2-year Treasury yield, 122 to be exact. That is the second time in 3 quarters we have seen a move of a full point or greater. Then, of course, there's been big moves in commodities moving to the downside. WTI down 24%, back down to $80 a barrel. And then amid all that selling pressure across those 3 asset classes, one stands out to me, Bitcoin, up 2.8%. I'm just going to leave that there. Then to get back to the equity story, I want to note that it's really not just about the end of the quarter number, because we have been on a roller coaster ride over the last 3 months. At one point, we were up 14% on the S&P 500 as it rallied from June to mid-August. Then it reversed even harder with a 16% drawdown from that peak. That is the biggest drawdown from a quarter high on record. And this will mark the first time since 1927 that the benchmark is closing a quarter with a negative return after earlier rising more than 10%. Finally, the asset class I haven't mentioned yet would be currencies. We have to talk about the strength of the dollar, and I'm not really sure if I need to say more than just showing you the WCRS function on the Bloomberg terminal, which shows how currencies around the world have performed against the US dollar. Everything on the screen is red as the greenback has had its best quarter since 2016. It's the dollar's world, John, and everybody else is just forced to live in it.
They're suffering in it, that's for sure. Katie Lyons, that stat on the turnaround in the last quarter is phenomenal. Katie, thank you. Coming up, Meta, joining a growing list of companies slamming the brakes on hiring.
The labor market with our suppliers, we're seeing absenteeism that interrupts our supply chain. The inflation's hitting all of us in all parts of our business.
And that conversation up next with Morgan Stanley's Matt Hornbeck.
Thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
With a major energy crisis and possible recession looming, Italy heads to the polls. Keep it tuned to Bloomberg for up-to-the-minute results and analysis of what it all means to you. Bloomberg, your global business authority.
The labor market with our suppliers, we're seeing absenteeism that interrupts our supply chain. We're seeing a lot of input costs coming in for premium shipping and parts. So it's really the input costs are going up. The inflation's hitting all of us in all parts of our business.
That was the Ford boss, Jim Farley. Meta joining Ford along with a host of other companies hit by rising prices. Meta initiating a hiring freeze with plans to restructure and reduce headcount for the first time ever. The chief, Mark Zuckerberg, saying in remarks obtained by Bloomberg, quote, "I had hoped the economy would have more clearly stabilized by now, but from what we're seeing, it doesn't yet seem like it has. So we want to plan somewhat conservatively." For more, let's get to Ed Ludlow here in New York. Morning, Ed.
Morning, John. This was part of a weekly Q&A that Zuckerberg holds with Meta employees and how hope fades, right? This is a company that in its near 20-year history has never reduced headcount. Yes, these are not layoffs, but what Zuckerberg told employees were where people leave, they will not backfill. They will really increase scrutiny on performance-based reviews, and if you don't step up, then you're out. This is what we're talking about here. And what I find staggering is in the most recent quarter, this is a company that had 80,000 global employees but added 5,800 new workers, and how quickly things have changed. It's about advertising, right? You look at the macro picture and what Meta's dealing with. Ad prices have come down significantly. They are pivoting to video to compete with the likes of TikTok and YouTube. Well, video carries less revenue in the ad space because you have to share that revenue with creators. And they have Reality Labs, this future proofing unit that's losing $3 billion a quarter. Something had to give at some point. But again, this was part of a 2023 budget review. The macro conditions are not what the company hoped, and they're making significant changes. And let's just bring up the long list of names. And this is a long list of names across corporate America that are either freezing hiring or making active reductions in headcount. This is not just technology, although you look at some of those names, they are those that are coming out of the pandemic era, former darlings into now out of favor tech products, but also broader. I'm talking, of course, about the automakers and Walmart as well, John.
Ed, thank you, buddy. Hiring freezes. That's the phrase there. It's important. Let's sit on that. Morgan Stanley's Matt Hornbeck joins us right now. Matt, can you fire what you can't hire?
John, thanks for having me on the program again. And I think that's a great question. That's exactly the point here, is that if you're sitting there in the C-suite and you're looking at reducing your labor force, you have to be really confident that you're not going to need them back in 6 months. Because if you do, you're going to have trouble finding them probably, but you're also going to have to pay up for them. And that's a really difficult decision, I think, for the C-suite to make these days. So you really have to become pretty pessimistic about the outlook. And that's where I think the equity market plays a big role, John.
So, Matt, this is something RBC said, connected to where this conversation is going. We have said that job losses, when they materialize, are likely to be relatively modest. But what if earnings get really dinged up here on the fact that the volume of spending is declining and maybe gets worse as central banks around the world slam on the brakes? Matt, are you saying we should pay more attention to what is happening with earnings, to what is happening with stocks, than what is happening for the labor market? Should the Fed be paying more attention to just that?
Absolutely. I mean, our chief equity strategist, Mike Wilson, has been flagging corporate earnings and the downside risks to them for quite some time now. That's exactly what we're thinking, John, is that the equity market probably has further to go down. That should have a negative influence on CEO confidence. You know, CEOs and small business owners should probably become more pessimistic about the outlook. And then that will translate into either more hiring freezes, a beginning of a layoff cycle. And that's ultimately what needs to happen to this economy in order to slow down demand. John, the PCE inflation report that we got this morning was another upside surprise.
Yep.
That's on the back of an upside surprise to CPI. So we're getting strong inflationary pressures coming through from the demand side here, John. This is less a supply story these days. It's more of a demand story in the United States.
I can count 9 consecutive weeks now of 10-year yields climbing, just about again this week as well. Matt, from a growth perspective, this bond market is screaming for lower yields, and we're not getting them in a massive way, Matt. Why is that?
Well, I mean, John, what's going on in the bond market really comes down to this dichotomy between understanding that the Fed probably has more to do raising interest rates, tightening financial conditions, but then what we have going on outside of the United States, the energy crisis in Europe, the slowdown that we're seeing in China, these factors tend to weigh on the long end of the yield curve. So we've gotten a tremendous flattening in the term structure of interest rates in the United States. We at Morgan Stanley think that there's more to go there. So the curve is really telling you quite a lot about what's going on in the world today.
Where does that leave the dollar call, Matt? Because you guys have been big dollar bulls.
Absolutely, John, and we're still dollar bulls. We think that the dollar has further to go into the end of the year where we see it topping out. You know, we don't think the dollar goes up forever, of course, but you can clearly see in the global growth differentials, the monetary policy divergence that we're seeing between the U.S. and Japan, most notably. You know, these are types of factors, John, that keep the dollar moving higher in our view. It's not forever, but nothing is forever. We think the dollar tops out later this year, but we're still dollar bulls.
Matt, what's the circuit breaker for that? What leads to that dollar top?
John, I think it could be a variety of things. You know, obviously, sentiment is key here. Sentiment is going to probably worsen as we get closer to the month of January, which is historically the coldest month in Europe. There's a lot of concern around just how bad the winter in Europe is going to be, what that is going to mean for the demand side of the energy complex. There's a lot of uncertainty around that, John. I mean, I don't believe what the weatherman tells me about the weather tomorrow, let alone how cold Europe will be in January.
I'm with you.
I think once we get closer to that period of time, John, there will be a sentiment shift making our way into 2023.
Matt, can you leave us with a number? Dollar yen 144. Euro dollar right now, 97.35. What are you looking for year end?
So we're looking for 150 on dollar yen, John, and then on euro dollar, we have a 93 target at this point.
There we go. Matt, it's been too long. Don't be a stranger. It's good to see you. Matt Horn back there of Morgan Stanley. Thank you, sir. Coming up, the morning calls and later, the warnings from corporate America piling up. Bank of America's Jill Carey Hall, Evercore's Julian Emmanuel, both joining us around the opening bell. Really looking forward to that conversation. As we count you down towards the open, 7 minutes away, equities declining just a touch. We're down 0.2% on the S&P. Live from New York, this is Bloomberg.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We're seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
Katie said it, we're staring down the barrel of another quarterly decline on the S&P 500, the longest quarterly losing streak going all the way back to 2009. Futures right now down about 0.2% on the S&P, on the Nasdaq down by 1/3%. That's the equity story. Here's the bond market picture. Just about ready to squeeze out another week of gains on a 10-year yield. 9 consecutive weeks of it. Yields in today by 7 basis points on a 10-year 371, off the highs of the week so far, north of 4%. That's the price action here in the morning calls. Your first call from KeyBank downgrading JB Hunt to sector weight, saying recent channel checks point to weakening demand. JP Morgan cutting its Alibaba price target at 135, growing concerned about the company's sales outlook due to China headwinds. And finally, Citi cutting its Nike price target to 93, highlighting a challenging backdrop and continuing supply disruptions. That stock is down by 13% in the pre-market. Up next, investors bracing for earnings season. That conversation with Bank of America's Jill Carey Hall and Evercore's Julian Emmanuel. The cash open up next.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. Welcome to Bloomberg, the lineup.
Here we go. Let's get you to the weekend. Live from New York this morning. Good morning. Futures negative just about, down 0.25% on the S&P. On the Nasdaq 100, down 0.4%. On the Russell, the small caps lower by about 0.25%. That's the equity market story on a session. There's your opening bounce. Switch at the board and get to the bond market. Yields lower by 7 or 8 basis points. Your yield 371 on 10s. Euro dollar negative 0.75%. Double-digit CPI in Germany yesterday. double-digit CPI in the Eurozone this morning. Euro weaker to 97.44. Crude lower by 1.3%, $80 and about 16 cents. That's the cross-asset price action about 15 seconds into this. Here's your movers. Here's Abby.
John, let's start out with one of the stocks that you were mentioning, dig a little bit deeper, one of today's big stock stories, and that, of course, is Nike, down 12%. Its worst day since 2001, absolutely plunging. This, of course, on that earnings miss, the gross margin miss, having to do with bloated inventories, shipping costs, inventories up 44%, plus, of course, foreign exchange. They also cut the fiscal year outlook, gross margins about 200 bips worse than expected. So this stock really plunging. Apple is one reason why the futures and now stock market, the S&P 500 cash is actually down. Earlier in the pre-market, up 1%. Apple had also been higher, now down about 0.6%, heading to its worst week since June. This, of course, all driven by that U-turn on the production boost, down about 20% on the year. So a bear market there. Still trading at 22 times the high end of the 5-year range. So this stock, even though it's down 20% on the year, is still expensive. Micron popping higher, up 0.8%. They have a supply glut, but apparently folks not caring, thinking that next year is going to be better. So interesting to see a supply glut for both Micron and for Nike, different industries, but similar problem. And then finally, Meta Platforms, it is up 0.6%, 0.7%, of course, in that hiring freeze, restructuring, the competition coming from TikTok, the economic outlook and environment weighing on ad spending. What's interesting about Meta right here, it's hitting on long-term support. It's trading at 9.7 times next year earnings, John. Some folks are going to start to look at this one as a bargain hunt.
Abby, thank you. Speaking of bargain hunts, Nike getting absolutely slammed, and I imagine a lot of inventory is going on sale. Just something to think about. Something to think about. Personally, just in case you... That's what I'm thinking of, Taylor. New sneakers, maybe. Tried to get the Brazil jersey for the World Cup later this year. Sold out already. There's going to be problems. I'm already anticipating it. The S&P down by about 0.1% on the S&P 500. Big tech wrapping up a really messy 3 months. With more, here's Ed.
Yeah, we're softer by 0.1% on the Nasdaq 100. A not bad end to what's been a horrible quarter, John. I think what's so staggering is this is the third straight quarterly decline on the Nasdaq 100. We haven't had a streak of quarterly declines like that since 2002. The biggest laggers in the quarter, some of the chip names so downtrodden, but also there's more speculative corners of the market, your Zooms and software stocks. What I find so staggering, let's bring up this next chart and just hover in it just for a minute. On August 15th, we were up 19%. On the Nasdaq 100. What changed? Well, the Fed on September 21st. What didn't change? Inflation and the direction of travel. And I'm really sorry, John, to end this quarter on a downer, but I'm going to do it. Is not great. We're resetting earnings expectations going into third quarter earnings where we expect more bad news. That list of names which account for a bulk of the market cap decline on the Nasdaq 100, we spent the last 3 years talking about how they're recession proof. But in a recession, earnings expectations get reset anywhere from 10 to 20%. It's not going to be good, John. And what improves it? No idea.
Don't apologise for it, Ed. You don't own it, sir. That's for sure. The S&P down by about 0.1%, 3 minutes into the session. I want to talk about Nike as well, down 12% in early trading. Nike and Micron really setting the stage for a pretty challenging earnings season. The latest results shedding light on the supply headwinds gripping corporate America this year. Taylor Riggs has more. Hey, Taylor.
Okay, away from the Nike running shoes, John, into the fundamentals of a balance sheet. Here we go. Take a look at Nike, and of course, the big number was the inventory. So on an overall headline number, inventory up 45% year over year. North America alone up 65%. Poonam Goyal yesterday, within 2 minutes of the press release, joins us on the call and says, yes, inventory is going to be the story. And it was unclear yesterday, I think before the call, if it was just ordering ahead of time to get ahead of the holiday season, or if indeed it was more of a backlog. And I think we're learning today, not only on the call, but of course the price action today, that it really is just sort of a backlog of things that they need to cut prices, clear it out, and do a big reset for the holiday quarter. As you mentioned, I guess the good news for the consumers are the deflationary forces that come from a bloated inventory on the balance sheet. And so maybe we have that to look forward to. The street really looking for a big reset this morning as well. You know, Ed had sort of alluded to this. The tale of two stories is Micron. Also looking at some pricing issues when it comes to some of those memory chips and some big oversupply. But interestingly enough, the street actually okay with this because Micron comes out on the call and also says last night
First half of 2023 going to be weak, but looking for a big pickup in the second half of 2023. And so the street saying that actually they're going to be looking forward to that as well. And don't forget the CapEx big cut as well with Micron too.
Now back to the running shoes. You had a look, didn't you?
Okay, so I don't wear Nike marathon running shoes, but if there is a discount, I could be tempted.
You might have a little dabble. Have a look. Taylor, thank you. Just out of interest, what do you wear for marathon running?
Ooh, I do On Clouds. My race on Sunday.
Okay.
I'm wearing my Ons, so we'll see.
You're racing Sunday?
I am.
What's that in?
The another marathon.
Another
number
one?
14.
This number, really?
Yeah.
You've done, Taylor Reese, good luck to you.
Thank you.
Thank you, as always. Investors bracing for a host of earnings downgrades now. A lot of results coming up over the next couple of weeks. Kelly has more. Hey, Kelly.
Hey, John, I'm just kind of distracted right now because I run like 3 miles max. So good for Taylor on that one. Now, as Taylor gears up to run a marathon, we are actually gearing up for earnings season because JP Morgan will be kicking things off just 2 weeks from today on October 14th. And we are expecting earnings will be much more slower in terms of growth than we saw in the second quarter. 3.1% is what is expected for the third quarter, but it is expected to pick back up at the end of this year and early in 2023. The question is whether those really accurately reflect what the reality might be. You've had a chorus of voices on Wall Street talking about how earnings expectations are still too high. All that said, they are moving lower steadily. So for 17 weeks in a row, we have seen downward earning revisions outpacing upward earning revisions. That is modeled there by the Citi Earnings Revision Index. And Nike, with its margin pressures, is a perfect example of what some of these strategists have been warning about. The idea that you have cost pressures on the one side and less of an ability to pass on those higher input costs to the end consumer when you have to do things like work down inventory and work with reduced demand. And another thing that the companies have to contend with in this environment is foreign exchange headwinds. The stronger dollar can be a big issue for big multinational companies that get a lot of their revenue overseas. And that is reflected in the market action we have seen so far this year. High international sales companies are underperforming those with no international sales. Those foreign exposed companies down about 25% on the year, John.
Kelly Lyons, awesome work as always, Kelly. Thank you. Greg Peters of PGIM just writes in on the Bloomberg terminal just to let us all know he bought a new pair of Dunks. If you want to contact Greg Peters of PGIM, tell him congratulations. We're happy for you, Greg. I'm happy you got involved in the Nike sale as well. Joining us now, Bank of America's Jill Carey-Hall and Evercore's Julian Emmanuel. Jill, you and Savita have been bearish for a while now. Have you seen enough pain yet?
Hi, John. Thanks for having me. Yeah, we've been targeting 3,600 on the S&P 500 for year end, so we're obviously much closer to that target. We're expecting a mild recession next year. I think if near term we see some more pain, there could be further downside risk to the market as earnings expectations, as was just mentioned, continue to come down. Those have been pretty sticky for the S&P 500. Consensus has still been looking for mid to high single digit earnings growth, 7 to 8% next year for the S&P, which we think is much too optimistic. So as those expectations continue to come down, market could remain volatile, sentiment could continue to deteriorate. If the recession's worse than expected, we've highlighted a floor of around 3,000 to 3,200 could be the worst case scenario on the S&P 500, but certainly getting closer to our target.
3K to 3,200. Julian, could it get that bad?
It could. Look, to us, the key is how the bond markets react. We all know that when you look at 2022, you can talk about earnings, you can talk about the micro, but the biggest story is the fact that the stock bond correlation has now flipped to positive after 25 years of risk on, risk off, and yields rising parabolically the last several weeks have dragged stocks down. We actually think this is an interesting time to step in and look at longer dated treasuries. But from an earnings perspective, we're looking for 0% year-on-year growth next year. We're below consensus for 2022 as well. So the risk certainly is downward in that respect.
Julian, let's pick up on that bond call. Said earlier this morning, the bonds don't work, they make things worse. Why are they a buy now?
Thinking about it this way, John, is on the short end, we know the Fed's resolute. We know the Bank of England has work to do on the short end. But yet at the long end, I think, again, they're likely to be tested, the Bank of England, again, perhaps next week, perhaps over the coming weeks. But there was a line in the sand drawn to preserve financial stability by bond buying. And obviously, we've seen that spill over into U.S. bonds as well. And from our point of view, if Ed Hyman's base case is 0% growth in 2023, and inflation break-evens are pretty darn close to 2% right now. That's a compelling case for long-dated bonds at these yields.
Let's take Hyman's growth number and send it over to B of A. Jill, where do we need to take down earnings expectations? And can you help me understand just a little bit more clearly how these big tech players will stand up to a major cyclical challenge without the fiscal transfers that consumers received and businesses were relieved by lower interest rates as well in the pandemic? How will they stand up to this cyclical challenge?
So we think earnings are slated to decline 8% next year. So earnings recession, not as bad as a typical earnings recession during an economic recession, assuming that this one will be mild. But we do see downside risk to earnings across the board, but particularly in some areas like consumer discretionary, where we think margin expectations have been very elevated. Labor costs are the biggest cost for U.S. companies. Wages have remained high. So consumer has been one area we've been more cautious on. I think tech is another area that, investors could be too sanguine about, how defensive tech is since it held up well during COVID, obviously. But we've seen tech, especially parts of, communication services, remain extremely crowded by investors. Tech is not as defensive in our view as some might expect. I think, when you look at fundamentals, the NASDAQ and earnings revisions there have been, coming down relative to earnings revisions for the S&P 500. So, you're seeing that weakness fundamentally there. Growth stocks are still relatively expensive and over-owned relative to value stocks. So we've been market weight the tech sector and underweight communication services.
Julian, I'd love your thoughts on that, just how defensive the tech sector is on the S&P 500 in a world where you think this bond market could start rallying.
Jill actually nailed it. The fact that the bond market could start rallying certainly does, at the increment, bode well for tech and growth. But the fact remains that these multiples are still high, particularly when you think about a rising yield environment generally at the short end, coupled with inflation, albeit starting to come down, still very high. And as Jill said, the fact is that professionals have been adjusting their weightings to growth over the course of this painful year, but the public still owns too much growth relative to the rest of their shareholdings, and that is certainly a headwind.
Can I get one buy from both of you? If you had to put some cash to work, and there's a lot of people watching right now that have put a lot of money into cash and out of stocks and out of bonds because everything's been so volatile in the last 3 months. Julian, if you had to put some cash to work in this stock market right now, where would you put it?
We think healthcare is very interesting here. The thing about the healthcare sector is, A, it's relatively inexpensive, and B, it tends over the long term to be much more immune to fluctuations in both interest rates and in currency, both of which are, the central eyes of this hurricane.
Jill, final word?
Yeah, we agree large cap healthcare looks interesting. I'd also say overweights U.S. domestic small caps. We're seeing a historic valuation gap between small and large cap equities. Small caps have been, much more adequately pricing in the risks around, U.S. economic recession, inflation, and they stand to benefit from some of the trends we're seeing. CapEx growth in the U.S. holding up very well. Companies might need to spend on CapEx more than they would during, if we are in an economic recession, given the need to automate. Wages are still high. Companies are reshoring manufacturing. So CapEx beneficiaries, domestic small caps, that's an area that we like.
I think we just did a whole market segment without talking about the UK. Liz Truss says thank you to both of you. Jill Carey-Hall, Julian Emanuel, to the both of you, thank you. What a week for everyone in this market. Equities down by about 0.2 on the S&P, the NASDAQ trying to squeeze out some gains. Coming up, a week marked by massive central bank intervention.
It's really important to step back and ask yourself, what has this week told us? It's been very sobering and we all feel exhausted, but we learned a lot.
Totally exhausted. That conversation up next.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
If you're not really in this space full time, I think it's very hard to run a successful crypto fund.
What are the moonshots at Amazon that are capturing most of your time and attention?
Well, you know, we have a unique way that we look at big new investments, and I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? If we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do, and any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine, and in the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs, you know, and the ultimate output for a company is share price, you know, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
Watch Bloomberg Surveillance Early Edition for the news you need when you need it.
I'm Matt Miller with Kaylee Lyons in New York and Anna Edwards in London.
I'm going to be watching retail earnings from both Home Depot and Walmart.
Then surveillance for in-depth analysis.
Alongside Tom Keene and Elisa Abrambitz, I'm Jonathan Ferro.
Across the board, these are good numbers.
And the big headline there is reaffirming the outlook.
How much does this give faith that you can get some sort of resurgence in consumer spending?
Bloomberg Surveillance. Be informed. Be prepared. Be ahead of the game.
We learned that you can get a major policy slippage in the G7 countries with mature institutions. We've learned that liquidity can evaporate in mature markets just like that. We've learned that the most boring element of the non-banks can be a systemic risk. We've learned today inflation is still a problem in Europe and the US. And the last issue is what you just raised, this tension between monetary policy and financial stability. You know, we need to absorb this.
Great to have Mohammed's guidance through the week so far. What a week it's been. Equities down just a little bit at the open on the S&P 500 by 0.5%. Data moments ago with that data. Here's Abby.
Indeed, John, and it's coming in as a miss. The Chicago PMI for the month of September coming in at 45.7 in contraction territory, below the previous reading and also below the expectation of 51.8. Interestingly, it's also below the overall U.S. PMI, which for the month of September, the preliminary number was 49.3. So Chicago doing worse. This is the worst PMI reading. Again, 45.7, deeply in contraction since 2020. Their economy, of course, lots of transportation, manufacturing, printing, publishing. When I think of Chicago right now, John, it's also, of course, moving Citadel down to Miami, making a $250 million donation, but that city in a bit of hurt. And again, that big move down by Citadel down into Miami. Different from this PMI, but nonetheless, worse than the nation and in contraction.
We've seen a few of these regional Fed indicators look really, really soft. Seen a lot of that, seen a lot of this. Volatile markets throughout the whole of this week, fueling, triggering some central bank intervention, leaving officials to grapple with how to curb financial risk while reining in prices. This coming as EU ministers race to contain an energy crisis amid double-digit inflation. Your team coverage starts right now with Bloomberg's Ed Harrison down in DC, Maria Tadeo in Brussels. Maria, walk me through what the EU has agreed on, just at a time where Putin is making a series of headlines in the last hour.
The reality is, Jonathan, today we did not get anything new. That's the reality. And I'm surprised markets are reacting to this because everything they agreed today, this was a formality. Von der Leyen had already presented a lot of this 2 weeks ago. Remember, this was a windfall tax for European companies to separate potentially gas from electricity, the mandatory reduction when it comes to the use of energy. That is going to be key heading into the winter. The big question, and this is still the big unknown here, is will European countries agree on a cap on gas? And that is still unknown. We know that there's frustration, that there is a clash of views. There's a number of countries, 17 countries, by the way, I'm being told now, including the French, the Italians, the Spanish, the Belgians, who are pushing for this cap. But the Germans continue to say they worry about the disruption that it could create in the market flow. So not a lot was agreed today, but you see, and this is what's key to me, that verbal intervention from the Europeans actually does go a long way.
A week full of intervention. Ed Harrison, sum up this week for us. Intervention everywhere I look.
Yeah, I think so much intervention that you really wonder how much longer it can go on. It's not just what happened in the UK, but you know, just today we saw a record amount of dollar buying by the Bank of Korea because the won was under pressure. You know, we know that there's intervention in Japan as well. So the real question is how much more systemic risk can we take going forward? I think the numbers that came out today from the U.S. in terms of inflation, that came out yesterday in terms of consumption, suggests that the Fed has to keep on going. But the financial stability concerns are creeping in, and I think that we have hit peak hawkishness, and that means that the Fed will soon abate and go down to 50 basis points instead of 75.
Ed, earlier in this hour, I asked Mohamed Al-Arian whether this Fed would still be doing QT by the time we started 2023. What's your view on that?
Yeah, I think that it's going to be very tough, especially because that's where the liquidity concerns are. The liquidity concerns are most prevalent in the safe assets. I think that when you look at what happened in the UK, that's a warning sign to every single central bank in the world, especially here in the United States, where there's been reports, even from research out of the Fed, that there are liquidity concerns. The swaps market is getting very spooked. Those are signs that we're under stress and that people are seeking safe havens, and that market is not clearing in the way that it should.
What a week. How many times have I said that this morning? What a week. Edward Harrison down in D.C., Maria Tadeo in Brussels. To the both of you, fantastic reporting, as always, here at Bloomberg. The S&P down 0.2, about 23 minutes into this. The NASDAQ basically unchanged, trying to squeeze out some gains. Up next, I'll bring you the trading diary and a sneak peek of next week.
A landmark climate bill passes through Congress. The expansion of nuclear energy and more investment for companies at the forefront of the fight against climate change. In this episode of Bloomberg Green, we'll explore President Biden's climate bill.
I almost think there's no superlatives that capture the breadth and scope and scale of this law.
Find out what's actually in it and where it doesn't go far enough.
The thing that's not included here is a specific hard cap on CO2 emissions or a specific legislated goal.
And look at what more needs to be done to invest in modernizing and greening U.S. infrastructure.
What we haven't had is a plan that's realistic, time-bound, pragmatic.
I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing this weekend on Bloomberg TV, Quick Take, and online.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Closing out the month of September and the third quarter as well. 25 minutes in, the S&P 500 totally unchanged so far. On the week, though, down on the week, down on the month, down on the quarter, we're down on the year. That's your equity market. That's the price action. Here's your trading diary. The UMich Consumer Sentiment Survey at the top of the hour. President Biden discussing recovery efforts for the hurricane at 11:30 Eastern Time. Plus, Fed speak continues throughout the day with Bauman, Barkin, Williams on deck. Looking ahead to next week, more Fed speak obviously kicking off on Monday. Plus, U.S. manufacturing PMIs and ISM numbers. And then September 7th, got a payrolls report as well. I can tell you, just a sneak peek at the survey so far as we put that together for you. 250K is the median estimate at the moment for non-farm payrolls in America. Your previous number, 315. The actual number, about a week away. From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
Thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sci-Fi stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fiero's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Benegold as an opportunity to leave that troubled home. Benegold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Benegold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Benegold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Wiener Gold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is a lot of them are younger investors who are looking to hone their skills.
Tech in right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, The hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. But while that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. Education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor. Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. Very good. 9th class. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation, a language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
Refer to the dictionary also, okay, and find out the new meanings, as well as you're going to describe about. Hey, Richita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW, and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or, a musician in this world. So these are the positive images that are associated with the identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gaulidoddi campus, and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future, she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We brought a lot of extracurricular activities, and most of them got institutionalized now. So, for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced the golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools.
Wow.
So our intention has been to give all 360 degrees, type of opportunities to the students so that, whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change all that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university and then I faced worst form of discrimination in the universities. Like there were, in those days I'm talking about, so the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand and then again, try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park, and inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use.